Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. I want to get through a couple of issues now that the political wrangling is over. We do have a post-election economy I want to talk about, and the essence of the mortgage market, which has gone through some changes, and several questions on tariffs and deficit spending. A quick look at the numbers, and I want to emphasize what we have is a strong economy. We don't have an economy that's recovering from a recession. We never had a recession, and we're very likely not going to have one in the foreseeable future. We have a fundamentally strong economy. The service ISM is up at 56, and it's probably going to be in the 60s by the first quarter next year. Manufacturing has gone through adjustments, but it's slowly catching up. Initial claims are, down. A little more on that later. And everything else is very low and positive. The only abnormality here is mortgage rates went up and all the interest rates went up, basically the day after the Fed lowered rates. I'll get to what that really means here in a minute or two. But for jobless claims and what's going on in the labor market, and forget the media hype, it's the last 5 years of jobless claims in the weeks of the year. And there is nothing unusual about 2024 in here. It is moving along as the U.S. job market has always moved along. Income and spending has normalized. You take all the noise of the COVID incident out of the numbers, and it has normalized back to where it was, a little more prudent spending. And clearly, you look at all the ages, and this is age demographics, including, first time I've heard people over 78 called traditionalists. Maybe I've missed it. But the whole bunch here, from millennials to traditionalists, are not overspending. They've cooled it. They've gone through their consumer demand after COVID and now have settled back down. And we've already talked about credit cards and debt not building up too fast. Personal savings rate is indicative of an individual who saves money isn't necessarily worried about their future, so they spend the money they make. Most of the nations on earth, they have very, very high savings rate because they are fundamentally worried about their future. Your basic American, you can say all you want about, they spend too much. They spend a lot. They have a lot, and they're not worried about not getting a lot more. That's just the way we are. One of the big components in inflation, which continues to abate, by the way, is wage and benefits growth. And the growth is coming down. It'll be down below 3 here pretty soon, which is kind of where it ought to be. The rest of the wage and hour people still need to come up a little more because they are behind, and I've been through that before. But the growth everywhere else in the inflating side is coming back down. The piece of post-politics I do want to talk about. Some people call it the Trump trade or the Trump bump. Basically, the day after the Feds lowered rates, the bond market said, I'm looking for a lot of reasons to sell. When they sell out of the bonds, that means rates go up because prices go down. Bonds work inversely to stocks. The bond traders, commonly known as the bond vigilantes, started selling. They started selling their 10-years. They started selling everything, which drove rates up. And they moved a lot. And it wasn't necessarily pointing the finger at Mr. Trump saying, there's going to be serious deficit spending. We'll get to that in a minute. It's more that they were looking at opportunities elsewhere. And a lot of this money went to the stock market, which we'll talk about in a minute. $12 billion left the gold market in about 4 hours. And huge dollar amounts into the dollar itself, dollar-denominated assets globally. The dollar is going to continue to be strong and remain strong. This is very indicative of how sensitive this marketplace is to changes in rates. Once the bond vigilantes start selling out, rates go up. 500,000 refinance applications disappear because the rates went up about that much. But I'm not going to refi. I'm going to wait for the new bottom. Okay, that's a philosophy. Now, where that new bottom is going to be, we'll talk about that in a minute. But the stock market did the same thing. Here we are doing okay. And if you look all the way to the right, that little whip, that's the Trump bump in the stock market. All of a sudden, people started buying everything. A lot of money from the bond market, a lot of places, enthusiasm, pro-business, that kind of stuff. The stock market's overpriced. It needs to correct. It will probably correct sometime between now and when the Fed lowers rates again, which is December 18th. It shouldn't be dramatic. It just needs to come back down. It was at a fine place following earnings. Earnings are okay. Profit margins are okay, a little over 12. The economy's doing fine. Industry's doing fine. From my side of the chair, I look at things like fear of lack of liquidity, people worried about actual number basis problems in the economy. And one of the places I always like to look is what the Fed Reserve is doing with its bond holdings. Now, we talked about this, well, I've probably talked about it too much because the Federal Reserve bought a lot of stuff from the banks and put liquidity in the market. Well, the market doesn't need liquidity anymore. The bond positions that the Fed holds are being sold, and most of them are being just run off to give the Fed the opportunity to pull that money out of the system, which is what they're doing. This is fundamentally good news. This is feeling that the banks and that side of the investing market are confident of what's going on right now. So the Fed's getting rid of their bonds, and the market's not suffering. That too is very good news. A couple of questions on tariffs. And that's fundamentally how you feel about deficit spending, which we've been doing. Fiscal 24 just ended here a little while ago, and we were basically about 8% of GDP. The deficit was about 8% of GDP. That's too much. 4% of GDP, we can live with that. A 4% deficit spending budget runs about 2% inflation, and that's okay. But historically, this is how tariffs have been used by the U.S. government. Boys, we were popular in the 1700s, 1800s. You know, you collect duties on ships that show up in port. Tariffs are a sales tax. As an example, a Chinese product shows up on a boat in Long Beach, and the importer is charged a tax from customs on that stuff that's on the boat. Well, the importer pays it. So the importer increases his wholesale prices, which means that prices increase on the shelf. And done correctly, what a tariff does is equalize that low-priced or lower-priced Chinese product compared to a higher or differently priced American product. So you take the buying decision based on price alone off the table. So then you pick on whatever, quality, color. That goes with cars, that goes with tools, it goes with shoes, it goes with everything. Now, if there were to be a huge flood of new tariffs tomorrow, it would still take 18 months to get it straight. The customs, the rules and regulations on those tariffs are mind-bogglingly complex. Anyway, the point is, if there are tariffs coming, if you look at the little gray slot right there that says customs, that's kind of the income we get out of customs right now. It's about $77 billion. It's not a lot. Majority of the money for U.S. government revenue is individual income taxes. That's about $2.5 trillion. Then FICA and Social Security and Medicaid and all that kind of stuff. That's almost $2 trillion, a little under $2 trillion. There's the majority of the ballgame. That's where most of the money comes from. There'll be a lot of political wrangling on corporate income taxes. That's the green. It's only 10% of the whole enchilada. Customs, if they double the tariffs, that might go from 3% of the pie to 4%. Maybe. And it's going to take a while. But that's the only place they can really expand revenue. What they're going to have to do is cut expenses, which I'm assuming the current administration will. And yeah, there was a question. That little black 2% that's stuck out there looks kind of weird in income. That's the state taxes. That's probably not going anywhere in the foreseeable future either. They could make a big deal out of it and really irritate a lot of folk, but actual money, no. It's income taxes and payroll taxes. That's the whole ballgame. So what we have here is we're going to go in and wrangle a little bit about the budget. And my suggestion that the Tax Cut Job Act that's due to sunset at the end of next year, well, it's a safe bet right now that's not going to sunset. That's going to keep going the way it is. They'll just get revenue someplace else. And you're never going to have, I shouldn't say never, but you're very likely not going to have no deficit spending. That doesn't endure very long. But 4% of GDP or less, that's okay. It's just too high right now. Well, I'm okay with the questions. It's fine. Send them along at info@shjwealthadvisors.com. I'm happy to deal with them. I appreciate you joining me.